Good morning, everybody. Welcome again on our IFRS 9 webinar, the second one in the series about financial instruments. I think today we have a two very interesting topics which are not so easy and where I think a lot of people may be struggling with. The first one will be about expected credit losses. And the second one will be about, do we have a financial liability or do we have equity? Yeah, I don't need to go to the logistics. I think most of the people already attended my webinar, so you know it. I think I added again the slide deck in the handout section. If you were not able to download it, send me an email and we will send it to you afterwards. So yeah, like I said, today we will talk about the impairment of financial assets and specifically expected credit losses, which is quite interesting. Interesting in the sense that from the start of IFRS 9, your impairment will also include the probable expected credit losses that you don't know yet, and you will make an allowance for that. We will deal with that immediately. And then, like I said, the distinction between financial liability and equity. We will discuss quite a lot of examples. For example, a convertible debt. For example, preference shares that are redeemable at certain cases, shares that are redeemable when you leave the company with a good leaver, bad leaver clause, or that are redeemable only upon liquidation of the company. We'll talk about options that you have on non-controlling interest, etc. There's a lot of examples to give. I tried to focus to those that are most common for corporates. Of course, it is not complete. There can be very different kind of instruments or with terms of instrument that are a bit different than the examples that I have been giving. But I will try to give you also the principles about that so you can also deal with that. If there are any questions, you can ask them through the questions pop-up. I think there's a questions pop-up or chat that you can ask your questions, and we'll try to respond to them during the webinar. If not possible, it will be after the webinar. So impairment of financial assets. So what is the difference between the old one and now IFRS 9 is already applicable for 2 years now, so as of the 1st of January 2019. But we will have moved from an incurred loss model. So I have incurred a credit loss because I know it's probable that the customer or the trade receivable will not be collectible. That's an incurred loss model, and I will make an allowance for that, to an expected credit loss model, meaning that, well, I just have now a very current accounts receivable. What is the probability that this may lead to a default or may lead to a credit loss? And you will recognize an allowance for that. So it's a totally different model under IFRS 9 than under IAS 39. And important, it is in the scope, it is applicable to all financial assets with 2 exceptions. Financial assets, is it equity or debt, which are measured at fair value through profit and loss, because inherently this is tackled in the fair value, or equity instruments measured at fair value through OCI. But important, debt instruments, financial assets which are debt instruments measured at fair value through OCI, which is possible when you're based on the business model that you have. In that case, it is applicable, and the impairment requirements are applicable to this one also. Yeah, and the big thing is in expected, like the word says, expected, is that you will need to include also forward-looking information. So it will include judgment, and that will be the difficulty in determining. You can base yourself on historical information that's available. I will show you some loss models that uses that also, but of course you need to include forward-looking information, also information about changes in your credit collection process, for example, that may have an impact on the future expected credit losses that you need to take into account. But I will come back on that later. There are two types of expected credit losses measurements that we'll have to do, and it will all depend on the credit risk that you have, and there will be some practical expedients or practical exceptions that you will be able to move directly to lifetime expected credit losses. But what is the difference? A lifetime expected credit loss is the credit loss that you expect from a possible default. A default is that the debtor will not be able to pay partially, a portion, or all of the receivable. And lifetime, it's over the expected life of the financial instrument. That's very important. Important expected life, of course, is not longer than the contractual life of the instrument. I think that speaks for itself. So what's the expected credit loss then? It's the difference between the contractual cash flows under the contract, and so the contractual, based on the contractual terms, the contractual cash flows, and the cash flows that you expect to receive over time, over the contractual period, contractual life of the instrument. That difference is your lifetime expected credit losses. Of course, you use expected over the future. When you determine expected credit losses, you will also discount it but I will show you that in an example. On the contrary, you have the first stage, and I will come back on that also later. You have the 12-month expected credit losses. The difference between the lifetime and the 12-month is that here, you always look to possible defaults within the next 12 months, based on your analysis on 31st of December 2020, and I will only look for the year 2021. I will not look beyond 2021 to evaluate whether there's a possible default event. That's the big difference. Of course, when you see that, is that the expected credit loss under the 12-month approach will be lower than under the lifetime always, because the longer your instrument is, the contractual life of your instrument is longer, the more risk you have that there may be a default event. Okay, very often, of course, but that's both with the 12-month and the lifetime, but certainly with the 12-month expected credit losses, that you will use probability of defaults. And that will be the difficulty. How are you as corporate? They call you, the companies that are not banks, I call you corporates. What is the probability that this customer or this debtor will be in default? But let's deal with that later on. So when do we need to apply lifetime expected losses of 12 months? You have 3 stages. That's a general approach. There will also be a simplified approach that I will explain you also later on. And that's only applicable to certain types of financial assets. You have 3 stages. The stages are always, normally a debtor will start in stage 1 and may or may not go into stage 2 or stage 3. What you will see, the general approach, that's an approach that will be used always by financial institutions, but it's always required to be used by corporates for certain types of financial assets. For example, if I have a long-term loan granted to a vendor, for example, or to who else, to a third party, that will be part, or you will have to apply the general approach. So stage 1, what we call the performing stage, is that in that case, we will determine only the 12-month expected credit losses. When is a financial asset in stage 1? When it has a low credit risk. Low credit risk can be, and I will also come back on that, if you go to the ratings, it can be those that are in the investment grade ratings and not in the speculative ratings. But I will come back on that also later. Or, and that's important, there's no significant deterioration in the credit quality since you have initially recognized the financial assets. When you have that, so if, for example, between 2020 and 2021, a non-current loan granted to a third party initially has a low credit risk because it has a AA credit rating, and at the end of 2021 it still has its AA credit rating, for example, then you will have to, it's still in stage 1. You will see that when it have moved credit rating, for example, to triple B, then of course you may have an issue here because there will be a significant deterioration in the credit quality. Credit ratings, that's very often not available for companies because if it's a private transaction between two private parties, well, very often you will not have a credit rating unless the other company has a public rating because it has issued public debt, for example, then it may have public ratings, but very often that's not the case. So there will be judgment applied whether or not this is a low credit risk. Low credit risk, I will give you also definitions, is that it's not probable or it's very unlikely that there will be an event of default. So you have to apply the 12-month credit losses. When you're going to evaluate, because impairment, you will have to evaluate at every reporting date. Is it now interim, quarterly, 6 months, or year end? You will have to evaluate it. When you see that there's a significant deterioration in the credit risk, then you will go to stage 2, underperforming. And then you will have to determine the credit loss based on the lifetime expected credit losses. Or when there's an event of default, for example, then you go into stage 3, non-performing. The recognition of interest, that's important here because when you have a non-current loan, for example, you will apply the effective interest rate method. The effective interest rate method, you will apply it on normally the gross carrying amount. If I have issued a loan of 1 million with an interest of 5%, I will determine the interest on the 5% on the gross carrying amount. It's like that in stage 1 and stage 2. In stage 3, however, we will apply the interest and the effective interest rate on the net amount, so the gross amount minus the allowance. So that's what I mean between gross and net. Gross minus allowance given me by net carrying amount. And why is that? It makes sense because in the stage 3, it's unlikely that, or it's probable that even the interest for the portion that you, the interest for on the portion that you have made an allowance may not be collectible. That's why you calculate your effective interest rate on the net carrying amount, so your amortized cost. Okay, a practical expedient, but like I said, if you think it's a low risk, it's always in stage 1. Is the credit risk higher than low, then it will go to stage 2 or stage 3. But I will come back on that with some examples. What is the impact? I will try to show it into a graph. When you see here, when you need to do the 12-month and suddenly it moves from stage 1 to stage 2 or stage 3, you will see suddenly a big step up because suddenly we need to estimate the credit loss for a lifetime. So not only 12 months, but if I have a loan, for example, of 5 years, 12 months is only 2021. If it's lifetime and the loan was issued at the end of 2020, I will have to look until 2025. So the longer the period, the higher the risk that we have a deterioration in the credit quality and that we may have an event of default. So you will see a setup between the 12-month and the lifetime expected credit losses. Economically, that's the dotted line here. Economically, of course, this is not like this with a sudden step up because this is the model in the general approach. Economically, it is like the graph is shown. It's a nice graph. It can be straight. It can be here. It's not straight. It depends a bit. So that's a way to differentiate about. To show you in a graph what is the event. So let me show you an example here. I took a simple balance sheet here. to show you how to apply whether or not impairment is applicable. So first of all, it's only on financial assets. So goodwill, property, plant and equipment, investments in joint ventures, inventory are not financial assets. So those are not subject to the impairment analysis for financial assets in the expected credit loss. The first one we see, I have issued a convertible loan to a joint venture. You could say, oh yeah, that's a financial asset, it will be in scope. Well, not. That's, I think, if you remember the first session that we had, a convertible loan will not meet the contractual cash flow characteristic test from a debt instrument, which is one of the requirements besides the business model to deal with the debt instrument when it can be amortized cost or another element. Because there's an embedded derivative in it, is the option to convert into shares of the joint venture, for example. In that case, it will always be fair value through P&L. And like I said, the impairment is not applicable, is not in scope for instruments that are measured at fair value through P&L. So you cannot, like we said, you cannot separate the embedded derivative, the option, from your instrument here for financial assets. It is possible for financial liabilities. I have an interest-bearing non-current loan of 500,000. There you will have to apply the general approach. If I have a low credit risk, it will be the 12-month expected credit loss. If I have a higher credit risk, it will be the lifetime expected credit loss. Contract assets, specifically here, contract assets are also in scope. So contract assets that result from IFRS 15, for example, the unbilled, the performance to date, which is unbilled, which could be a contract asset. That's that's a financial asset. And there you will have to apply the simplified approach unless there's a significant financial component, financing component included. If that's the case, you will have the option, the choice between a general approach and a simplified approach. I think very often companies will use a simplified approach. And there, if it's simplified, always lifetime expected credit losses. In the other ones, we have other receivables, short-term investments, cash and cash equivalents. You need to use the general approach. You also see cash and cash equivalents. It is also in scope. So the impairment analysis is in scope for cash and cash equivalents. Of course, there because if your cash is with a financial institution with high credit rating, like the Belgian banks, there will be no impairment loss because you will use the 12-month expected credit loss in that case, and it's unlikely that there will be a credit loss event for that one. Okay, one thing I want to mention here that I showed you is that in theory, because it's all current, is your 12-month expected credit loss equal to the lifetime expected credit loss? Because the contractual term of your current contracts is less than 12 months, otherwise it would not have been current. So that's right, unless of course it's a short-term portion of a non-current interest-bearing loan, and that will have a contractual maturity of more than, it will be part of the general approach in that case also. So that's a way to show you, if you take a typical balance sheet, how the impairment applies. Maybe I mentioned already, what is a default event? And I think that will be a bit surprising because everybody will think about default. I will default as, okay, there's an event that the debtor will not be able to pay, or it's unlikely to pay in the foreseeable future. And there's no recourse, there's no security that we have to recuperate it into another way. And that's a definition of a default event that we know. But one thing is here very important is that also they say, well, a default event is also, for example, when the financial asset is more than 90 days past due. And you will say, well, oh, if we think about our financial assets, and you will need to think about the trade receivables, oh, we have a lot of financial assets, trade receivables that are more than 90 days past due. It can happen, it's part of our business. Well, do I have a default event then? Do I need to write off the full amount? No, It doesn't say that. Even for a default event, you will estimate what's the portion of it that may not be recuperated or collectible. But default event results in a lifetime expected credit loss. That's important to know. Where's the 90 days also coming from? As you know, IFRS 9 is a very big thing in financial institutions. And from there, the 90 days is coming. You will also see a 30 days threshold for significant deterioration in credit quality. But it's coming from there, but it's part of the standard. So take it into account, and very often in your accounting policies, you will mention the 90 days, or if it's a different days, you will mention it. But again, it doesn't mean that you need to fully write off, because the default can also be a portion will not be paid. And also, it doesn't matter, because in the example of trade receivables, you will always use the lifetime expected credit losses, and the lifetime expected credit losses equals, it's the same thing if it's no default or significant deterioration, stage 2, stage 3, it will be the same. So it will be measured the same. What's a significant change in credit risk? So default was stage 3. A significant change in credit risk, which is the stage 2. Yeah, I think that will be the difficulty for corporates. It's maybe not so difficult, or less difficult for financial institutions, but more difficult for companies, because how can we estimate the credit risk? And there we will have to use quantitative but also qualitative information in your analysis. So quantitative will be, for example, the status in which aging bucket is it, or is the long-term receivable they missed 2 times an interest payment? I think that may be an indication of a change in credit risk for a company. So you will look to historical experience about payments, about informed credit assessments that you have obtained in a way, but also forward-looking information. For example, if I now would have a receivable or a loan granted to a party who's offering services, for example, to restaurants and to bars, for example. Well, there you may have forward-looking information because of COVID. Yeah, you may have indications that, well, we may have an increased credit risk here. In that case, I will have to move to a stage 2 or maybe a stage 3, for example. There's a practical application or expedient, like I said, is that when it's low credit risk, then you can have an assumption that there's no significant increase in credit risk has occurred. Although I will show you another example in the next slides, I think. And there's also a rebuttable presumption that credit risk has increased significantly when contractual payments are more than 30 days past due. So when they have missed a payment after more than 30 days past the due date, for example, again, an interest payment or a principal payment, then you may have a significant increase in credit risk. The only impact is that you move from the 12-month expected credit loss to a lifetime expected credit loss model. And I will show you immediately the examples. Some examples of indicators that are factors that you can use, but they're not limited. It's just a few examples that I show you is that look to external market indicators of credit risk or financial instrument. With the same life, you could use maybe it's more financial institution related, but I know certain corporates may also have some non-current elements, a big portfolio of non-current financial assets or debt, which are debt instruments, where you may use credit spread or credit default swap prices for the borrower. You will look to the external credit rating if it's available. You will look to the operating results of a borrower. You see that they're making significant losses. They have made an announcement that they have missed a covenant. Well, there you have a significant change in credit risk for the debtor. You will see that I have as collateral, for example, a building or shares, for example, as collateral, and you see that those shares have decreased significantly in fair value. Well, that may be an indication of an issue in credit risk. guarantees, changes in the support letter from a parent, for example, to a subsidiary, etc. And the 30 days past due. It's a rebuttable presumption. Rebuttable means it's not because it's 30 days past due that it's always a significant change in credit risk. So you can, it's a rebuttable meaning you can explain why it is not a significant change. But rebuttable, you need to explain why, and that's what we mean. If you look to the credit ratings, I have mentioned here the most common ones. I think Moody's, Standard & Poor's, Fitch, I think those three are the most common ones. DBRS, yeah, those are also mentioned. I don't think this is very, very common. What you see here, you know that I've mentioned investment grade and speculative grade to determine whether or not the credit risk are low or not. So the blue ones are investment grade, meaning it's a low credit risk. The yellow ones or the orange ones are a speculative grade, meaning I have a higher risk, a higher credit risk. Why do I say that? Well, if you look to the definitions, for example, of Moody, of the last one in this investment grade, the BAA, well, this means obligations rated BAA are judged to be medium grade or subject to moderate credit risk, and as such may possess certain speculative characters. This one in Moody's is already between investment grade and speculative grade. If you look to the definition of Standard & Poor's, there we see for BB that they say, well, it's low, adequate capacity to meet financial commitments, but subject to more adverse economic conditions. Indicates that expectations of default risk are currently low. So in Fitch, they specifically say for BBB that credit risk is low. So the practical experience is if you have certain bonds, for example, purchase, and they are in the blue line, well, from the beginning, you can say the credit risk is low, for example. Of course, you can say, well, and when I'm starting with double A, that's almost difficult to find these days or impossible to find. But if I go from double A or A and I move to triple B, well, then you know that there's a deterioration in credit risk, and you may have an indication that there may be a significant decrease. So that's something still to, even if it's within the investment grade. But that's something you can choose because there's a practical experience. If it's in general low risk, you can stay into the stage 1, the 12-month expected credit losses. So an example here, and that's an example where we will calculate in the general approach the 12-month credit losses and the lifetime expected credit loss. But for example, company A has purchased a 5-year corporate bond, it's publicly quoted, for example, of company B for 1 million at the end of December 2019. And the corporate bond was issued at par, so there's no transaction costs, so that's also will be my carrying amount, my gross carrying amount in the beginning. And the credit rating for company B is A, so it's still a low credit risk. So on initial recognition, it will be low credit risk because of the A. I will recognize the 12-month expected credit losses. You see in the blue one here, let me show it to you what I want to be. The blue is that we have a 12-month expected credit loss to determine. So I recognize the gross amount of 1 million and I will recognize an allowance. So it needs to be a separate account. You cannot show it net. You can show it net, of course, in your statement of financial position, but you will have to explain it in the notes between an allowance and the gross amount. So you have a gross amount of 1 million and allowance of 2,500, irrespective whether the 2,500 is material or not. Very often that will not be material and you will not book it maybe or recognize it. What's the exposure here? At the initial recognition, it's 1 million. So it's the cash that I have paid for the bond, the nominal amount. 2 years later, at December 31st, 2001, suddenly for company B, the credit rating has been revised to triple B minus. Triple B minus, if you look back, so it's a deterioration of the credit rating, and the company may argue, well, for me, that's a significant deterioration of the credit loss. So I will have to determine the lifetime expected credit loss. That's stage 2. So on December 31st, 2021, the loan has shown significant increase in credit risk, and I will recognize an allowance of 46,914. Still, it's an allowance. My gross amount will be not, I mentioned here 130 because there's an interest payable. I mentioned an interest, which is still has to pay. Okay. I will immediately show you the calculation of the amounts. And stage 3 is the lifetime expected, because on 22 there's a default status. They're not able to pay the interest, for example. So I enter into a default status. The interest is due more than 90 days. So I will recognize, I will determine again the lifetime expected credit losses, which is in that case 441,359. The exposure is still 1.3. So a default doesn't mean, again, that everything will not be paid. There can also be a portion that will not be collectible. So how did we now calculate those amounts under the general approach? Let's go now to some examples here. You will see that it's, again, very often that's you say, well, no, that's only applicable for banks. Maybe true. I think in banks, that's the way they deal with it. But I think also for that cases, in the example that I give you, it's something that can happen. If you would have bought, for example, bonds of FNG, for example, a year ago or 2 years ago, well, you will have to apply this general approach, and at the end, you would have a default event. And whether you will recuperate the full amount or not, you don't know. So it may happen. But let me show you what it means. And then afterwards, we'll go to the simplified approach for trade receivables. In that case here, I had a bond of 1 million, 5-year term, 3%, it's the same thing. So what I'm doing in the stage 1, I will put up my 5 periods for at the beginning, 2020, 21, 22, until 24, which is the maturity. What is the exposure? In the beginning, it's only 1 million, and then every time, because the interest is paid only at the end, after the end of the year. So in January 2020, the interest is paid for on 2019, for example, and that's why we always have here 2030. So what you then do, what's important here? For each period, you will determine what's the PD is the probability of a default. What's the probability of a default? I think that's the big difficulty of companies. How can you estimate whether this is 1%, 5%, 10%, 15%? I think I know this is a very big challenge. Need to be judgment. I think important here is that you, of course, in banks, they have a whole history of doing things. So because they're also with individuals and with companies, so they have a whole history to determine the probability based on certain factors. For a corporate, that's very difficult. But I think there it's important that you apply it on a consistent basis. That would be important. But what we have, so we have a probability of default in that year. In the beginning, it's 1% and it's increasing. Why it's only 1%? Because we have a low credit risk. So it's very unlikely that there will be an event of default. That's why the probability is very low. Again, if it's 1% or 2%, I think that's your judgment. And then we're saying, well, what's the cumulative probability? It's just the sum of 2.5 here is a sum of 1 plus 1.5. And 5 is sum of 1.5 plus 2.5, which should be 4, I think. That's I see here already an error in it. You see, I don't know, it's 2.5 plus 2.5. Sorry, it's 5. It's correct. 2.5 plus that, it's 5. That's a cumulative. And then we have also the loss giving a default event. So here I'm saying when I have a default event, I estimate that 25% of the exposure will not be collectible. 75% will be collectible. When a company is, for example, bankrupt, at the end you will have a 100% loss default event. It will be 100%. So how do I calculate now my 12-month expected credit loss? I have 1,030,000, it's my exposure, multiplied by my probability, multiplied by 25%, discounted back for 1 year. because I'm calculating it at the beginning of 2019, so we'll discount it 1 year at the discount rate. The discount rate is the effective interest rate into for the bond, and then I'm coming up with 2,500. So the present value at 3% of 1,030,000 multiplied by 1% multiplied by 25%. That's my expected credit loss. That's my 12-month. If I would have calculated my lifetime, you will calculate for every year the same thing. So 130 multiplied by 1.50, the marginal, 25% discounted here 2 years back. That's my amount. The sum of those amounts is 30,000. That's my lifetime expected credit loss. So that's how you calculate 12-month and lifetime. When you go, that's also the amount that you have seen in my stage 1. When you go to stage 2, we have a significant deterioration. It's at the end of 2021. 2021, so I will look forward for 1 year, 2 year, 3 years. You will see my marginal probability has increased. 4, 5, 10%. It's not credit risk maybe low anymore. Still, the loss giving default stays the same. 130 multiplied by 4, my 25% give me 10,000 for my 12-month expected credit loss. Lifetime 46,000. You see it's increasing from. So I will recognize initially 2,500. In stage 2, I would have recognized an allowance of lifetime. It's 46,000. And then we may go into, in my example, to a default event. And the default event here, like I mentioned here, is that we may have different scenarios here. I can have a default where that at a certain point that it will still be recoupable. It will go back to a stage 2, for example. It will not default at the end. Then I will calculate here. In that case, I will have the same thing. My marginal probability have changed. So I have here 66,000 lifetime expected credit loss. But I think the probability that this scenario will occur is 25%. It's my estimate. It can be a bankruptcy that happened in year 2, and I will only recuperate 25%. So then my default is 130 multiplied by 100%. When it's a bankruptcy, multiplied by 75. 75 is because I will still get 25% of my the amount that I have invested back. So I have an expected credit loss of 728,155, discounted at 1 year. That chance is 25%. And then they will do a debt restructuring, and we'll have to give a 50% debt relief. So 50% will maybe recuperated again. So I then do 130, 100% will not be recuperable for 50%. I have a loss of 485. In that case, still, you may also include that, and I did not include it, but there will also be a probability that the remaining 50% maybe will not be recoverable into the future. So you may have also, again, a portion for that, something I did not include. And the company estimates that scenario 4, it should be 3, is the most likely one, 50%. So what's my expected credit loss that I will recognize is the weighted average lifetime expected credit loss, 66 by 25, 728 by 25, that by 25, give me my 441,359. That's my expected credit loss, lifetime expected credit loss that I will mention here, that I will book here in the stage 3 when the company is in an event of default. See, very complicated for a general approach, and I know very often the companies will not apply it. Also because it's mainly on non-current, long-term, non-current financial assets, debt instruments that you may have to do that, and very often it's they have made it's still in a low credit risk, so you will have probably an immaterial 12-month expected credit, hopefully. But you never know these days with COVID-19 what may happen with the credit quality of certain companies. That's the general approach, so not easy. Fortunately for trade receivables, there's a simplified approach that we can apply. Fortunately, you can say the simplified approaches, well, you don't need to estimate stage 1, stage 2, stage 3, they apply the 3-stage approach. You can immediately estimate the lifetime expected credit losses. And this is mandatory for trade receivables and contract assets, so contract assets from IFRS 15 that do not have a significant financing component. So significant financing component may happen, for example, in IFRS 15 when you have trade receivables which are, when you have granted a kind of financing, they're only repayable after 1 year, for example. That may be a significant financing component. So it will be an element under IFRS 15 that you will have considered. And it's optionally for trade receivables and contract assets that do have significant financing component. So they have the option between the general approach, 3 stages, or the simplified approach. I know, and very often companies will choose the simplified approach. So, and there you will estimate based on the lifetime expected credit losses. It's still also, it is still an allowance. So a write-off is only when there's no reasonable expectation of recovery. Also for lease receivables, because that's also part of it, you use the cash flows that are used in measuring the lease receivable So how you have determined that. Lease receivable will happen when you are a lessor into a finance lease. Then you will have a lease receivable, for example, and that you will apply it. Or it can be when you have an operating lease, it's a lease receivable for the next period that they will have to pay, that they have not paid yet, their rent, for example. So the question is, how do I calculate that? And very often companies will use historical information. And I have here an example, which is a common one, but you can see other ones, because the company, the standard allows to apply a provision matrix. What is a provision matrix? It's you will determine certain percentages that you will apply on the aging buckets of the trade receivables to determine what is the expected credit loss that we have to apply. So it's a kind of general allowance that you will make, a general provision. How do we one example here that we can do is what I do. So I will show you. This is one that we use historical information. Of course, you may have adjustments for changes in the debt collection process, improvements, for example, or forward-looking information that can have a positive or a negative impact. So what I'm doing here, for example, in that case, I will determine what are my total sales in 2019. That's 10.5 million euro. And I will determine in 19, for those sales, the sales that I sent in 2019, what were the credit losses that I have incurred? So the incurred credit losses. In that case, it's 125,000. Important here, 125,000 are not the incurred credit losses on sales of 2018 or 17. So it's really related to invoices of 2019. So what I'm doing, what I put here, I have here a column, sales that reach the aging group. In the beginning, all sales reach an aging group. It's not overdue, always. It starts always when you send the invoice, it's not overdue. When you have a 30-day payment period, it stays not overdue for 30 days. So the 10 million goes into the bucket immediately, 10.5 million. Then you will determine what's the cash that I have received within due date. So of the 10.5 million invoices, how many invoices have I received that have amount of cash that have been paid within due date? In that case, it's 5 million. When I show you, this is all based on, for example, the invoice list that you have here. I have the invoice list that I have applied here. The only thing what I need to add is the date paid. That may also be a challenge, but normally you can get that from your systems. But for example, this first invoice here, due date was 30th of April 2019, 100,000 euro. It was paid just on due date, same thing. So it will come into the aging bucket 0 days overdue. So what does that mean? In that case here, the 5 million means 5 million of the sales were paid within due date. What happens then is the difference between 10.55, 5.5, that will move to at least 1 day overdue. It can be more, but at least 1 day overdue. Then I will look back again of those invoices when it was paid. When I go back again to my list here, I have this one, this invoice. It was paid in May, so within 1 month after the due date, so it will enter into the aging grouping of 1 to 30 days overdue. So if I go back to the slide here, 2.750 million of the invoices were paid within 1 and 30 days after the due date. So after due date, but within 30 days after due date. So I still have the difference here. I will still have 275,000 invoices that remains unpaid after 30 days. And then again, you will move 1,035,000 were paid within 31 and 60 days. 750 between 61 and 90 days. Larger than 90 days, I have 525. Here you see 125,000 is unpaid. This is my write-off that I have. Very often you will see that this amount is higher than your write-off. The amount ever paid will not equal your write-off, because it's common, for example, that you may have still receivables that are, I have clients that there's receivables that are even more than 1 year, which are not paid. And they're not written off. There's no allowance against to it neither, and because of valid reasons. Because, well, they're not paying because there's at the same amount a payable, or there's because there need to be a credit note sent that we have not done, but there's no risk that it will not be paid. For example, this is not, credit loss is not because of quality issues, because the company is not able in its financial capacity to pay. That's the definition of a credit loss. So it may happen, but you need to have explained the difference between this here and this. So what I'm doing then, I have my credit loss, the 125 on those sales, and I determine what's my historical credit loss rate. So I determine, in that case, I will, let me show you the Excel, I have it here. So it's 125 divided by my sales in the grouping, 10.5, that have 1%. 1% of the 10.5 million has a credit loss, which is correct, because at the end of this sales, I had 125% credit loss. Of this aging bucket, 5.5, so 125 divided by 5.5 give me 2%. So you calculate the historical credit loss based on the sales that reach each aging group. And these are then, when you go my outstanding balance, for example, at 31st of March 2020, in that case, that's my receivables that I have, my trade receivables, and I do 1% multiplied by 875, I have 10,000, and my lifetime expected credit loss is 46,160 that I calculated. And that's a way to determine these are the percentages that you apply on the aging buckets for your aging. That's the way. Of course, this is again only based on historical information. Do not forget to adjust those elements based on changes in the process and forward-looking information changes. It could be, for example, that because of COVID, that you have higher expected credit losses that you need to apply, which are not seen from the historical loss rate that you have incurred. So that's a way to determine the provision matrix and your expected lifetime credit losses that you have. And the big differences between the past is only in the past, only when it's more than 90 days, you would have made provisions, not for those ones. And here you estimate already of the 10 million, of the 875, I may have a certain amount of invoices that will move into the aging buckets at the end and will not be paid, will incur in credit loss. And that's 10,000 euro that I have estimated for that. So that's a way to calculate. Also important is that you need to, when you need to exclude the receivables that already are, they have recorded an allowance for incurred credit loss. Otherwise, you will have double counting. So those that are outstanding balances, those that are not subject to an allowance yet, of course. Otherwise, it will be double counted. All right, so that's the provision matrix. I'm not sure what are you using as an expected credit loss, but that's the way. I know certain companies are using this model to determine the provision matrix, and it's revised on a yearly basis. Okay. All right. Let's move forward because we're spending quite some time. Yeah, that's what I said. I think that's substantially the stage 1 to 3 and etc. Maybe one example here is that financial assets at fair value through OCI is that in that case, like I said, financial assets which are debt instruments at fair value to OCI, not equity, they're also subject to impairment. For example, I have a bond and I will contract your cash flow characteristics test, but I may sell it. I have a business model which is mixed, and then you may go into the fair value through OCI model. It can be until maturity, or I can sell it depending on certain needs and certain developments into the market. In that case, it's applicable. So in the example, I have 1,000 fair value on 26th of November, and I will measure it 5% interest rate and 10 years, and the effective interest rate also 5 because I don't have transaction costs. It's issued at par, so my effective interest rate is the same. So in the beginning, I will recognize 1,000 financial assets through fair value to OCI, and I will have a credit on the cash, of course. What may happen is 1 year later, is it 1 year, even a month later at the year end, I see that the fair value of the instrument has decreased to 950 as a result of market interest rates. And the entity determines that there's no significant credit risk since initial recognition. And I determine, so it's low credit risk, I'll determine the expected credit loss for the 12-month, 3% probability of default. So we'll have 30,000, 30 euro allowance that I will recognize. So I'll do a P&L impact. So that's here, it goes to P&L, although it's OCI, fair value OCI. I will recognize my impairment in P&L 30. I have my financial asset fair value to OCI itself, the change is 50. So the difference will go to OCI, which is the 20. Remember, here you can recycle your OCI into P&L. So you will offset the change in fair value with your impairment in OCI. And you will have to explain that into the notes. What will happen when you sell it? I will sell it for 950 because I will not incur, I don't want to have this risk anymore. Then I will have a cash of 950. My financial asset will be de-recognized for 950 because that will be my carrying amount. I will recycle my OCI of 20, I will put it into loss. So we will recognize finally a loss of 50, which is 20 from a fair value change, and which is 30 from an impairment over years in total. So that's the way how you will determine the impairment on financial assets of fair value through OCI. That's a bit, I think that those are the most important things you need to know. It's maybe a little bit too much already, certainly with the 12-month expected credit loss and the general approach, but I think it's good that you know it, because I think every company may have certain receivables that are subject to the general approach. And I think it's important to know what you need to do. All right, as a second part, and probably will not be able to reach everything at the end here. So we'll have to do it through the next session. And that's something I forgot to say in the beginning, as because we want to give you as much as information on IFRS 9. And IFRS 9 is one of the biggest standards issued by the ISB. We think also we may need a fourth session to explain you everything, because we also need to give you derecognition and disclosures. And the last session we foreseen was on hedge accounting. So we will send you an email that there will be a fourth session in January somewhere. At a good time, hopefully for you, because it's a year-end closing, that will deal with derecognition disclosures and maybe certain additional elements of liabilities and equity. Liabilities and equity, it's something that the question comes. Important here, this is not IFRS 9, this is IAS 32. So if you remember, IFRS 9 replaced IAS 39, but not IAS 32. IAS 32 deals with equity instruments, the equity instruments, and how do I need to account for that? So first of all, what is the definition of an equity instrument? And you will say, well, oh, I don't have that. Well, there's quite some examples. I must say, every year we see examples of elements where we need to do a determination. Is this now a financial liability or is it equity? So there are two main conditions that need to be met, and both need to be met together. First of all, the instrument includes no contractual obligation. Here I put it in bold. It's about the contract. You don't need to use probability, even if there's no contractual obligation, and although it will be settled by intention by management and cash. You don't need to consider that. So you don't need to consider intentions by management. You need to look to the substance of the contractual obligation, how it's contractually determined. Something that is not in the contract, you don't need to consider to determine if it's an equity instrument or not. And that's a very important element here. So it's include no contractual obligation, either one of them to settle the instrument in cash or another financial asset. Another financial asset can be, I don't know, it can be shares of a certain company, can be not inventory, it need to be a financial asset. So, but very often it will be cash, of course. So there's no contractual obligation for the issuer to deliver cash to the holder of the instrument. Or to exchange a financial asset or financial liability with another entity under conditions that are potentially unfavorable to the issuer. I think that's a very important one. You need to look to the instrument and whether or not there's an obligation. The company, the issuer, has no possibility to avoid in certain elements, certain events or conditions, the payment, the settlement of the financial asset in cash. And that's what it says. So it cannot avoid a cash payment. It can happen that it will not be settled in cash, but it cannot avoid it because there's a contractual obligation when in case of a certain event that it may happen. And then a second condition is that the instrument will be settled in the issuer's own equity instruments, of course. So if it will be settled in equity and own equity instruments, and it's a non-derivative, one moment, a non-derivative, and there, if it's settled, it needs to be settled in a fixed number of equity shares for a fixed amount, and that's very important, what we call the fixed to fixed test. So it needs to be a fixed number of equity instruments with for a fixed amount. So not the amount cannot change, cannot be variable, and also the number of shares that will issue cannot be variable. That's very important. In that case, there's no obligation, contractual rate to pay cash, and it will be settled in a fixed to fix. That you will meet the definition of an equity instrument. Let me go to this. I think that's a bit, we will deal with that with this very in the next sessions. So what in the next session with the next slides, I mean, what does that mean? A financial if it's a financial liability, it is in scope of IFRS 9. If it's not a financial liability, it's an equity instrument, it's in scope only of IAS 32, so not of IFRS 9. It also means that financial liability, interest, dividends, losses, gains of financial instruments will be recognized in income, in P&L, and transaction costs are included in determining the effective interest rate. And you will present a financial liability in your financial statement of position. In an equity instrument, the distributions are deducted from equity. Normally, transaction costs are deducted from equity. So if it's an equity instrument, it will not have a P&L impact. It will every impact, every gain or loss later on, or distribution will be recognized into equity. So I think very important. And we see often that companies say, well, in substance, this debt, for example, this is a subordinate debt. So this is an equity instrument because we're only in the last in the last stage of being repaid before all the other, after all the other lenders. Yeah, in that case, you said, well, it's very unlikely. I will consider that as an equity instrument. But you already see that this is not the case, because there's you don't meet the first condition, which is there's no contractual obligation to settle the financial asset in cash. And a loan that is just subordinated at the end, at a certain point in time, it can be paid in cash. So it will always be a financial liability. One of the first elements that we consider are the contingent settlement provisions. So only it can be that there's maybe a contractual obligation to settle in cash, but which are contingent on certain events, and events which can be likely or unlikely to occur. And very important here, that are beyond control of both the issuer and the holder. Beyond control, so neither the issuer or the holder has control over this event if it will take place. For example, it can be a change in tax law, a change in interest rate, a change in stock market. It can have different types of elements, events that can happen. In that case, it is always a financial liability. When you have, because as an issuer, I cannot avoid it. It can happen that we'll have to pay cash, unless, of course, there's no unless, so you cannot. It's no unconditional right to avoid delivering cash, unless, of course, that the contingent settlement provisions are not genuine. Genuine means that, well, the event that it will take place for a cash settlement is very rare, extremely rare, very unlikely to occur. In that case, you can still say, well, it is okay. For example, I have seen elements where they say, well, it will be the loan will be repaid in cash and not in shares when we see that at the moment of issuance that the loan is not in compliance with tax laws. That's a difference than change in tax laws. And you know at the beginning that it's compliant with tax laws, just a general provision, a general risk that they mention, a protective right. In that case, it would not be a genuine one. Or, and that's also important, the cash, the event is related to a liquidation of the issuer, an event of liquidation. In that case, also, it's you can treat it as if that's the only event, a liquidation event. Then it's also you can treat it still as an equity instrument. You will see that with puttable instruments that are only upon a liquidation event. And then also, if the instrument is classified under certain exceptions, we'll see that further. There's some other exceptions, but that's something you need to know. If it's contingent, and I cannot avoid it. In general, it will be a financial liability, because I cannot control the element. If I would be able to control the contingency, that's something different, because if the issuer only has control, not the holder, the issuer has control, then you can avoid it because you have the right to avoid. It's about rights. If you exercise, you can exercise it. It doesn't matter. It doesn't matter what your intention is. If your intention is to exercise this right, but we have the right to unconditional right to avoid, then it will be an equity instrument again. One of the things that you very often see in such contracts is that, well, it's going to be repaid in cash when there's a change in control. Because I think I have an example somewhere where the shares, I have issued shares, and the shares are being reimbursed by the company upon a change in control. That's that would be a very I have seen that actually in thing. And then it's the question: is the change in control or beyond control of the company? And there you need to look to what can trigger a change in control. Is the change in control only that only all shareholders in the shareholder meeting need to decide, and it's a general shareholders meeting need to decide whether a change in control will happen? In that case, you may have control, because shareholders and the company are seen as one element. It's one element that you see. So the company is also the shareholder meeting that you see it. In that case, you have control, and in that case, you can still have equity. Beyond control is that if an individual shareholder may decide at his own discretion to sell its shares. For example, I have an investor who has 65% of the shares. This party can, within the shareholder agreement, decide at its own discretion to sell its 65% interest to a third party. That may qualify as a change in control. It's beyond the control of the company, because it's not the shareholders meeting who decides. So that's an important element to consider. Other things, when can I have other elements of cash? I can have, oh, I'm paying dividends. So I have issued shares and I'm paying dividends. So this is a cash settlement. So I need to display it as financial ability? No, because the company has discretion about paying dividends. In that case, it's discretionary. It's at the option of the company to decide, and the general shareholders meeting to decide about paying dividends. It's not an obligation. In that case, it's within the issuer's control. It can be different. There can be preference shares, for example, that mandatorily you need to pay dividends at a certain percentage of the invested amount, and it's mandatorily that you need to pay it. In that case, you cannot avoid cash here anymore. It's not at the discretion of the company, and in that case, you may have a portion of this preference share that will be recognized as a financial liability. The financial liability will be the dividend payments that you will do. The present value of it will be your financial liability. The rest will be in equity. Upon the successful takeover of the issuer, this depends. This is change in control. See my previous slide. Event of default under any of the issuer's debt facility, I don't know. It's not under my control. Upon commencement of proceedings for the winding up, no, but here it's a liquidation winding up, so it's one of the exceptions. You can this contingent settlement provision, it doesn't mean then that you need to recognize a financial liability. It's not within the control. A change in accounting taxation, no, but of course it must be genuine, that one. It can have very protective rights here that they included, because we cannot control changes. You see that very often in certain share agreements also. So there you can use the criteria for genuine. Issue of an IPO prospectus, very often also is that when you do an IPO, you're going to be paid cash at an amount maybe of the price that we do an IPO. Can happen in that case. Issuance of prospectus you have under control. It's a discretion of the company to issue prospectus. Execution of an effective IPO, that you don't have under control. It's about effective. You can execute an IPO. It can also be not successful, but an effective IPO is that you have raised new capital from at the price that I intended, and it's subscribed with the amount that I intended. That's an effective one. In that case, it's difficult to know, because you don't have it under control how the new investors will subscribe into the IPO for the new shares. When I dispose all or substantial of the issuer's business, you have it under control also. So that's an example, a real life example that I have. It's a company, it's a private company that were acquired by a new investor, and they have issued two classes of ordinary shares. Have the A ordinary shares, which is subscribed by the founder and the new investor, and I have B ordinary shares, which are subscribed by management. So in that case, management was able to not to subscribe for shares. It's not a share-based payment plan, because they have already paid and received shares. The terms of A and B are similar, except for example, that in that case here, the B shares have a contingent settlement provision that in case the management individual person leaves the company, in that case, the shares will be repurchased. So you can say, well, there's a call option at the right of the company in this case of a certain event, which can be a bad lever or a good lever event. The bad or good lever event will determine the price that will be paid. And a bad lever event, we pay you back the issue price. In a good lever event, the fair value of the shares. And the company may decide at its own discretion to redeem the B ordinary shares to its holder at the issue price or the fair value, depending on the type of the lever event. In that case, like I said, it may decide at its discretion. So the company can avoid, has a contractual right to avoid a payment in cash. So they can decide, well, the person have left, I will not redeem it in cash. They can decide that. They have the contractual right. So that's very important here. In that case, I have the unconditional right to not pay cash. I should not exercise the call option. And also important, the call option should be settled gross, meaning I have an exchange, I will receive the shares and I will pay the fair value amount or the issue price in full. There's no net settlement. If it would be a net settlement, we have the derivative. Derivative will be fair value through P&L immediately. But in that case, very often it's settled gross. In that case, even the B shares will meet. Even if I know that management or the company has the intention, when they have a good or bad lever event, to exercise the call option. But because I can contractually avoid it, I can do an equity instrument. All right. Preference shares. Very often preference shares can have characteristics of financial liability. It depends a bit on what are the rights of the preference shares. I think I already explained one is a preference share which have a contractual right to obtain every year a fixed amount of a dividend at a certain percentage, whether there's a loss or a gain, for example, or a profit. Well, in that case, I may have a part will have to be recognized as a financial liability. I can have instruments that are redeemable mandatorily at the holder's option. So I, as a holder, can say, well, no, I want my amount back at a certain predetermined price. It will be financial liability because it's the holder's option. The company does not have the right to avoid a cash payment. If it's at the issuer's option, it's equity because again, it has the right to avoid. Instruments that are not non-redeemable. I can have preference shares that are not redeemable. But again here, and I think that's my example, not redeemable, but I have a preference dividend that it's paid every year at a fixed amount. Then I have a partial split account, a partial amount that will be recognized as a financial liability. Dividend blockers are a bit the same thing, is that if it's discretionary, as long as, for example, that's something very common, that one, is that preference shares will receive dividends which are discretionary, meaning if the company is paying to the ordinary shareholders a dividend, then first the preference shares will receive a dividend at an amount which can be also at a higher amount, and that's a dividend blocker. Or a dividend pusher is always that first it's preference shares and then the ordinary shares. It's a bit the same what we call. So here important, as long as it's discretionary. If it's a contractual obligation to pay a dividend, you will end up in the third line item. I will leave this slide to you. It's a very complex one. There's a lot of information on it, but it's about puttable instruments. And what is a puttable instrument? Is an instrument that gives the holders the right to give back the instrument that they hold for cash or for another financial asset. So you see it already. The holder has a right to ask cash back. And it's on the occurrence of an uncertain future event or death or retirement of the holder, for example. It can be. So in that case, there are 6 criteria that need to be met as when it can be an equity instrument. And I will not go through everything. Maybe you need to read that once. But it's mainly what you need to look at is, again, here is that, well, finally, it's an instrument that has when it will be liquidated, I have a pro rata share of the net asset, like a normal share. Every instrument in that class is subordinate to all other classes of instruments. Every instrument in that class of subordination has the same terms and conditions. There's no other contractual obligation to pay cash other than the event that may trigger a cash payment. The total expected cash flows over the life are substantially on the profit and loss, or the change in recognized net asset, or the change in fair value, and then two other criteria that need to be both met. But I think that's one of the most difficult ones, is puttable instruments. Some of them I already mentioned. Preference shares is mandatory redeemable. It's a puttable instrument at the holder. They can ask cash back at an uncertain or certain event, or at the option only. It's a puttable instrument and will not meet the definition of an equity instrument, but it will be a financial liability. And now go to some examples here that may come in. I may have issued perpetual debt. Perpetual debt is debt that has no maturity. It's into the eternity. It doesn't have a defined maturity. So that's a contractual right to receive payments on account or interest at fixed dates extended. Very often companies say, well, this is equity for me because it's perpetual, it doesn't have a maturity, so I don't have to pay back the principal. But what you see here is that very often is that normally it will be the case that the net present value of the interest payment that you will do over the life of the indefinite life of the debt will equal the principal at inception, of course, because you will go, if you apply as a discount rate the interest rate on the perpetual debt, it will be equal. And anyway, that's how it has been determined and how your interest rate has been determined. In that case, it will be a financial liability. For example, in that case here, I have issued a financial instrument. I will make annual payments in perpetuity equal to 6% of interest. At the principal amount of 1 million. So every year I will pay 60,000 euro. And the 6% is also the market rate. So in that case, my net present value will be also 1 million. So I will, at the end, I will repay the principal via interest at least. So in that case, the principal debt gives rise to a financial liability of the issuer. That's an important one. So perpetual debt, and almost always this is triggered, this is recognized as a financial liability and not as equity. Another example is subordinate debt. I think I mentioned already. Here also you see it already, subordinate debt. Well, I need to repay it. I don't have an unconditional right to avoid a cash settlement of the subordinate right, because if I'm in a good condition, I have a good cash flows and I can repay based on the terms and conditions, I will repay the cash. I have an obligation to repay it. So in that case, subordination will not lead to an equity instrument. Of course, you can consider it when you determine as part of your capital management, you can consider, of course, your subordinated debt as part of your capital just for the purposes of defining capital, but it's not presented as such. It's very often that you see that in financial institutions and insurance companies. Then we have contracts settled by delivery of entities' own shares. So I will settle a contract, and the contract will be settled by giving me shares of the company. Like I said here, very important here. Remember about the first definition of equity, the second column. We need to meet the fixed-to-fixed requirement. Very important. If that's not met, you will not have an equity instrument. A fixed number of shares for a fixed amount of cash. So a non-derivative contract involving the issue of a fixed number of own equity instruments is an equity. If it's a variable number, so for example, a convertible debt, but the number of shares upon conversion are not fixed. It depends on the market value of the shares at that moment. So, and based on that market value, I will divide the principal by the market value to come up with the number of shares. It's not fixed at inception, it's variable, so it will be a financial liability that you will have. And then also a financial liability, you may come up, because I have my embedded feature, conversion feature, you may end up in fair value through P&L potentially, normally. You can have a derivative contract involving the sale. For example, I have a call option on a shareholder for my own shares, and I will pay a fixed exercise price and a fixed number of shares that I can pay. A call option, in that case, it will be an equity instrument. So a call option on, for example, your non-controlling interest or shares of a shareholder, fixed to fixed, it's an equity. If it's not fixed, the amount, the exercise price is not fixed, then in that case, you will have a financial liability. If it's a derivative contract for the purchase of equity instrument, even for it can give a rise to financial liability, even if the initial recognition is a reduction to equity. But I will show you that later on, that one. You can have a derivative contract just when it's settled net, or it's a variable number, not a fixed to fixed. It will be financial asset, financial liability. Derivative contract with settlement options, normally financial asset, financial liability, etc. So you see a bit, or you also see, for example, a share option with step-up exercise prices. In that case, it may still meet, because if it's at inception, the exercise prices and the different kinds of exercise are determined and fixed, then it's still fixed to fix. Even if, for example, if the number of shares are variable because of a restructuring, because of, for example, a share split that you do, if that's the case, then it's still fixed to fix. So you can, that's one of the few of the exceptions about the fix of that. So let's take an example, a convertible debt. A convertible debt, which is a compound financial instrument. Compound meaning I have characteristics of a financial liability and also characteristics of an equity. The conversion option is equity, and it's the financial is the repayment of the loan. Also important, it's a non-derivative financial instrument. Very common is a convertible loan or mandatory redeemable preference shares, etc. So there we will apply split accounting. What split accounting is, we will determine the amount, the fair value of the financial liability, and the difference with the nominal amount will be recognized as equity. So we will not determine the fair value of the equity component. The equity component will be the residual value. Let me first show you the example here. We have issued a convertible loan of 2 million with maturity of 3 years, and the annual interest is 6%. And it will be converted upon conversion at the end of maturity at 250,000 ordinary shares. So in that, I have a fixed number of shares issued, 250, and have a fixed nominal amount. It's a 2 million that will be, because the 6% will be repaid every month. So it's a 2 million fixed amount, so we'll have fixed to fixed, so it meets the condition, I can continue. What we then do, we need to determine what's the fair value of the financial liability, as taking into account that there would not be a conversion option. So just how can we do that? I will look to the market, look to what I often do is look to the bonds issued, corporate bonds issued, and I will look for similar terms and amount if I can, in the range. Will certainly not be able to exact. Look to recent with the date also, and that will be an indication of the market value, the market interest rate when you would issue the loan. In general, that will always be higher because the conversion feature allow you to benefit from certain positive events. So if it goes very positive, I will convert. If it goes bad, I will ask my principal back, and at an interest rate of 6%. If you don't have the conversion option, you will very often have a higher interest rate applied. So you use that by looking to the markets on Euronext to the bonds, for example. And in the example here, I have 100,000 transaction costs. So what I will do, I will determine first of all what's the fair value of my liability component. Fair value of my liability component is the present value of the future cash payments. So the 6% on the 200,000, which is 120,000 interest per year, and the 2 million principal repaid at the end of 3 years. So that's all my payments. And I will discount it not at the 6%, but I will discount it back at the market interest rate, as if the financial liability was issued without conversion option. So the 9% is used as a discount factor. And the sum of those net present values give me 1.8 million, which is my fair value of my liability component. The difference with the nominal amount, the 2 million, the 151 is the equity component. So you will recognize the 151 in equity. I need to show you need to, of course, also deduct here the transaction costs. So and you need to do that proportionally. So because transaction costs are also part of the equity component, so I will do proportionally based on the gross proceeds, the net present value. I will determine what the transaction costs. The transaction costs for equity that are recognized directly in equity. Okay. What's very important here is that in the convertible debt, then what's recognized in equity will not be remeasured. It stays there, so it will always be at the amount of 144,000. The liability, of course, is measured, specifically measured based on the effective interest rate method. So I will determine again the effective interest rate, and I will come up. My effective interest rate in that case will be 10%. Why 10%? It's not a 9%, because I have deducted also 92,000 euro transaction costs. So my real effective interest rate is 10.9%. So the net present value of the cash flows is 1,775. What will be recognized? So that's how you account for it, and that here you will do the accretion up with the interest rate. That's how you do a convertible debt. I had one case where the market interest rate was lower than the interest rate on the loan, and was with the shareholder. Yeah, what you then do, because let me show you in the Excel here. If I would use my 6% and I would issue it, it's for example 4%, the market interest rate, then you would lead up that my fair value of my liability component is 2.1 million, so higher than the 2 million. So I have a negative element. You could think about it. Well, it's a call option. I will never exercise it. So it's my right. So I will recognize 0, and that will be the first instance. But because it is with the shareholder, it was in that case a majority shareholder, this has been considered as a dividend payment. So I will deduct it from the reserve, a dividend payment of 111,004, and I will recognize a liability component of 2.1 million. And that I will repay at a market interest rate of 4%. And in reality, I will pay 6%. So just as something that could happen, that actually I have seen happening at a certain company. But if it would not be a shareholder, the holder, of course, you cannot recognize a dividend because he has no shares. In that case, I think you will recognize liability at the 2 million, and there will be no equity component. All right. So I will just continue here, and then I think the next slides will be for the next session. Some considerations when I have an early redemption in cash. Here, first of all, if it's contractually arranged for the early redemption and there's an option, this may be an embedded derivative, one of the things important to know. But if there's an early redemption, you will calculate the fair value of the loan at the date of early redemption. You will determine the difference between the fair value and the carrying value, and that will go into P&L. And then the difference will be adjusted in equity. There may be contingent convertible features. It's still equity component, of course, if it's fixed to fixed, very important. Mandatory convertible bonds, that's an important one. If it's mandatorily convertible, there's no way to, there's no contractual obligation for the company to pay cash. It's because it's mandatorily convertible at a certain point in time. And if it's fixed to fixed, then and it's also in the same functional currency, then it will be an equity instrument. So that's one of the ways to have an equity instrument, is a mandatorily convertible bond fixed to fixed in the same functional currency of the entity. If it would not be the same functional currency, there, of course, well, the amount is not fixed, because the amount will change based on the change in the FX rate. So you will not meet the criteria for equity instruments. Voilà, I think, let me just, that's the example of the slide of the, when I do the step 4, I think I should have the step 4, the slide here should have been just before here, just to how we account for it at the end. Of course, when that's something I didn't mention, when we do a conversion at maturity, then you will de-recognize the financial liability and book this amount into equity, because this will be also the same amount, and that will be 2 million, and it will also be our capital increase. Even also maybe if it's an early conversion, for example, that we have. And if it's repaid at maturity, I will have 2 million because of my effective interest rate, and 2 million will be paid back. Okay. Yeah, so like I told you, there's a lot of things to mention. There's what I will discuss on the next session is a certain what you need to do with treasury shares and some derivatives on equity on instruments. For example, a call option can happen. I mean, we see that often that we have call options with certain shareholders for the company, or certainly with minority shares. And with minority shares, I have an example with a written put option. So you can have a right to purchase the shares of a non-controlling interest, but you can also have the obligation, and that's what we call a written put option. And that's something I will deal also with the next session about that. So thank you very much for your attention. Do not forget, so it's a 28. I will issue, probably will, I don't know, we'll have to discuss once to do a 4th session. I hope it's okay for all of you. But I think it's important that we tell you that we tackle most of the common topics, at least, that are applicable in IFRS 9 for corporates. So I wish you all a happy Christmas and a happy New Year. See you next year. There will be a little survey at the end. One moment, I just need to do a little survey. We can do a little survey here because we're doing the planning. What topics will be interested? So if you can just reply on the poll, and then I leave it all up to you. You can close the session, and see you all next year. Thank you. Bye-bye.